Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook. Well, this week we started off on Monday by doing a FOMO trade in NVDA. So NVIDIA announced earnings, blew it out of the water, and then showed some weakness in the stock. And I think it was just a little bit of buy the rumor, sell the news scenario. NVIDIA's had a real strong year so far, and they took that opportunity of the good earnings report to sell the stock off, and it came down, but it didn't come down extremely fast, right? It just was a buying opportunity. So on Monday, we looked at a long call spread, and we set it up where we straddled the marketplace. So we paid a lot of attention to how much time premium we bought versus how much time premium we sold. And on our trade, we were hoping that the underlying stock will get to the $505 range. That's where our upside call was that we had sold in our long call spread. And NVIDIA today is up about around $7.5 or about 1.5%. We're at $4.95. So the trade is looking good already. One of the things about the trade that we put on is we went on a little bit longer term on it. And if the market does actually ride all the way up to the 505 area, we talked about maybe rolling an entire spread. We had a question on that. And by the way, if you have any questions, please feel free to put them in the comment box. We'd like this to be a very interactive show here on Options Guy TV. We want to take advantage of the fact that we can interact with the audience. So if you have any questions about the NVIDIA trade on Monday, there's not much that I'm going to do to it. I will talk about an adjustment if it gets to the 505 range. That would be a nice problem to have here. Let's put it that way with NVIDIA. So today we're going to jump in and look at a bearish trade. We have September and October coming. September's right around the corner. It's going to be here this Friday. So you have the seasonality situation. September and October are usually the more volatile months. We've shown a chart on Options Guy TV that kind of highlights that usually the VIX index will seasonally be up in these months, September and October. We actually did a VIX trade centered around that. And so far, ever since Jackson Hole, and we see ever since Powell has talked at Jackson Hole, we've had a strong move in the SPX. We actually broke through the 4,500 level, which I think was, those big round numbers are a lot of times just a point of resistance. And we've actually driven the VIX down. Now, the September futures contract that we're basing our options off of hasn't came down as much as the actual spot index. And right now we see the VIX at 1448 going into September. A few weeks ago, it was about 16 and a half, 17 on the VIX. So strong move up in the SPX, strong move down in the VIX. That's very normal. We're going to try to get a little bearish, though. The market still is a little toppy. There's the news in general has been fairly decent as far as the economy is concerned. The consumer has remained strong. And don't let me forget about the consumer, because I'm going to preference a trade that we might do on Wednesday. And I'm going to come back to that as soon as we get done with the S&P 500 index trade. And, we had new home sales. They actually came out today, and those numbers were up again. They were higher than expected. And so that's just showing that there are, even though there are signs of weakness in the economy still seems to be holding fairly strong. Who knows what the Fed's going to do in September? There's a probability of a quarter point hike in the Fed funds rate. And right now that's right around 20% probability that that's going to happen. So it was 50-50. It's came off a little bit now. And that's what we're looking at in the September Fed meeting. So we got a lot going on. So we're going to get short. We're going to do it very, very safe, let me say, with very limited risk. That's the words or the phrase that I wanted to do here in the SPX. It is one of my favorite trades to do if I want to get bearish on a marketplace. And once again, on Options Guy TV, everything that we do here is just meant to be a learning scenario. So this is a trade that I have an alternative if the market continues this strength. And normally, I would wait for a down day to put this trade on, but I don't pick the days that we do Options Guy TV. So I don't mind putting it on today, right around the 4,500 level in the SPX, and mainly because we got September around. Let's hope we get some of that seasonality to be a little bit bearish for this particular trade. I don't want to be bearish on the markets in general, but for this particular trade, that's what we would like to see happen. So let's get to the trade. It's a little bit advanced here. For Options Guy TV, we're going to look at a long put butterfly trade in the S&P 500 index. And we want to pay attention right now. If I highlight my Trade Hawk options grid, we see that the market, SPX is up a little bit today. It's up 0.25%, which is about 10 points. At 45.10 is the most at the money option contract. I'm going to go a little bit out of the money. Now, I want to stay within the one standard deviation move, which is highlighted here on the Trade Hawk software. By the way, this is the call side of things. This is the put side of things. This graying, the difference in color on the chain represents about a one standard deviation move to the downside. So I want to be within that range, right? I'm hoping, I'm picking a middle strike on my butterfly that could happen by this Friday expiration, right? In other words, the marketplace says that it's within the one standard deviation move. It's a possibility, a fairly decent possibility of happening before Friday. So if you think about it, we're looking at 44.70. That's if you take a 1% move in the SPX, that would be about 45 points because we're at 4,500. So we were looking at about 44.65 based off of that would be the strike price. That would be about 1% down. So this is a less than 1% move, which it's a strong move in the S&P 500 index. And that's where we want that market to land. So here's the trade that we're looking at. We're going to use this Friday's expiration. The Friday is going to be September 1st. That's that will be this Friday. So here's our expiration date on our option grid. Here's where the underlying market is at. We're using the put side of things. We're going to buy the 44.90 strike put, and we're going to buy one of those. And then our middle strike, this is where we want the market to go if for this trade to be profitable, is 44.70. That's the middle strike. So we're going to do two of those contracts. We're going to sell it. And then our protection, our last wing of the butterfly is 44.50. Everything's equidistant, 20 points away. And we can get this done for a net debit to the account of $2.10 on the midpoint. Now, if you look at SPX option contracts and we look at where the bid is and where the ask is, they're extremely liquid markets. So I would assume that we could feel somewhere close to that midpoint. And we're going to make that the official paper trade for this Wednesday on Options Guy TV. We're going to be looking at buying the September 1st expiration 450 strike put, selling two of the 440 strikes puts, and buying one of the 44. I'm sorry. Let me say that again. We're going to buy one of the 44.50s, sell two of the 44.70s, and buy one of the 44.90s. We're going to do this as a gaggle of securities, sending it down to the trading floor as a butterfly, hoping to execute all three legs of this at a net debit to your account of $2.10. That means that you're going to have $210 worth of risk for every butterfly that you put on. And you always got to add commissions in there, but it's going to be limited to that amount. It's going to be limited to that amount total. So if the marketplace goes up from here, we're going to have an adjustment, and we'll look at that on our show coming up. But if we do that adjustment, we're going to probably be doing it tomorrow, right? There's not too many days that are left in this in this butterfly trade. And I'm very happy that we could get this trade off for right around $2. I think that that's a solid price on this butterfly. A lot of times I would expect this to be fairly close to $3, and the VIX is at around 14% implied volatility. But if we look at the option contracts right here, we're looking at the call option and the put option. We're right around 16% implied, right at the midpoint between the call and the put on the at the money option on the option contracts that we are trading. So it's a little bit higher than where the VIX is at, and hence we can get this done for a little bit better price than what the VIX would imply. That's simple. And it's only because it's a 2-day trade. So $2.10, we're going to get a little bearish going into September. And we're going to do it with the SPX. One of my favorite trades to do is, if I want to get bearish, it's in particular just in an index, is to use a butterfly. And then if the market doesn't go with me, I like to roll it into a short put spread, which would go from being a bearish trade easily to becoming a bullish trade. So if you have any questions, please put them in the chat box and I will try to address them before the end of this show. Okay. So to keep with the theme of retail, there's a trade that I want to lean into going into Friday's show, and it's all going to be dependent on their earnings. So if you look at Dollar General, which was a darling around the COVID times, and I'm going to pull up a chart here and look at Dollar General going out quite a bit in time. So let's go all the way back to the downturn in COVID. So Dollar General is going to be announcing earnings before the open tomorrow. I'm pretty sure it's tomorrow. Let me double check that. Yeah, it's going to be tomorrow. And so with Dollar General, they're going to be announcing before they open tomorrow. Just want 100% confirm that that's happening. And look at this chart. So what we see here is a big downturn, the last earnings report, and the market has just been chopped ever since then. But if you go all the way back up leading into COVID, it was a fairly decent chart. Obviously, a lot of choppiness over COVID. Look at what happened here. We went all the way from a low, like the low in the last couple of years here, all the way up to 260. And now we're all the way back down to the 155, 160, 155 range. So it's been this would make a very good roller coaster at a theme park. So right here, though, there's obviously a lot of noise, right? This is where we led into the COVID. We got the news, the pandemic was announced, and then people started to realize that people still need to shop. And where do they shop at Dollar General? But there might be a recession talk, so Dollar General kind of leads that way, and then all of a sudden it doesn't. And here we are. So if they announce earnings tomorrow, we could get speculative on it and actually do a trade going into earnings. I think I'd rather try to see what happens here, because we're right on a precipice. If they announce earnings and they're down, let's say 5% or so tomorrow, and that would mean I'd want to get a little bearish on the stock. And if they are up 5 or 10% tomorrow, then I might want to get bullish on the stock. But one thing that is scary about this, especially on the downside, is we've touched the underlying stock 155.08. And if we do actually break through, third time could be a charm. We've touched it a couple of times in this area. Break through to the downside, might want to get a little bearish on the stock. Now, the fundamentals of Dollar General are actually fairly decent. They're not that exciting, but it's trading at about 13 times earnings, so it's not really overvalued in that aspect. And they they pay an okay dividend. The dividend's about a 1.5% dividend yield on the underlying stock. Sales growth is about 7% a year, so it's not anything amazing. But there are some rationale behind if we do get a bounce and we are going to the upside, that maybe if you do believe that the economy may weaken going into the end of the year, this might be a stock that you could trade on a short-term basis, either bullish or bearish, depending on what happens with their earnings tomorrow. So wanted to preference that, show you that chart. If you do have any questions, please put them in the chat box, and I will try to address any and all questions that you may have. All right. So if I go back and I look at this SPX trade that we set up, and we talk about what our hedge may be. And in order to do that, because this is the official paper trade, paying around $2.10 for this butterfly. What we're going to watch tomorrow, if the market did go up about as much as we kind of want it to go down, in other words, we get a 40-point move or so to the upside, one of the things that we can do is we can sell the most expensive option contract and then buy another of our protection, the 45.50. Hence, rolling the strategy. If you, well, I wouldn't necessarily be rolling, but it would be adjusting the strategy to make it a short put spread, which is bullish on the marketplace. So the market would be up. Obviously, this trend to the upside would be continuing. We'd have 1 day for this trade to go before it goes away, and we would have an expensive short put spread on to put that trade on. So now, when would I do that? If I'm doing it and I'm going to adjust the trade, here's where the adjustment comes in. I am going to remove, I'm going to remove the center strike. And now we have the two long options. The most expensive long option is the 44.90, and that's trading for around $12. So what we'd be doing is selling the 44.90, and I'm going to put sell to open, even though it would be a sell to close. I'm going to put sell to open. And then because the position's not in the account yet. And then the alternative here would be to buy another of the 44.50s. Right now, we can do that for a net credit to the account. Let's call it $8, right? We paid $2.10. We could roll this into a short put spread for $8. And so if we go $2 minus 8, that means that you'd have $6 of total credit that would come into the account if we did it right now, right? So if we wait, and this would be my determinant here, if I see this spread trading for around $4, to me, from all my years of doing this, I would guess that would mean the market is probably up about 40 points if that happened. And that's just a guess, just a ballpark figure there. If that happens, then I would be tempted to roll into this short put spread. Why would I wait? Well, I'm still bearish. I'm just preferencing what we may do, and we would do it tomorrow. And we don't have an Options Guy TV tomorrow. But if the market did open up a good bit by, let's say, noon tomorrow, I would look at adjusting this trade by rolling it into a short put spread. So what you would end up with is you would be short 2 of the 44.90, or no, this 44.70s. So you'd be short 2 of the 44.70s from the butterfly, and then you'd be long 2 of the 44.50s. You'd have 20 points of risk, though, because you're in a short put spread, and you'd be in 2 of those, so that would be $4,000 would be the requirement. So you'd have to have the capital in order to put that trade on. But then you just want the market to stay where it's at. And you need it to stay there for whatever time is left on Thursday, and also all day on Friday. All right, so no comments or questions so far. And, well, we're a little bit early on the timing, but that's going to be it for this edition of Options Guy TV. Come back this Friday at 11 a.m. and we'll look at how this SPX trade played out. And I will get online tomorrow, look at the trade, see where we're at on Thursday. If the strength in the market continues, we will adjust that trade, and we'll talk about that adjustment on Friday. And then we're going to see what happens with Dollar General's earnings and see if we want to get bearish or bullish on Dollar General on Friday. All right. Thanks for coming, everyone. Please click subscribe, ring the bell, give us a thumbs up. It helps us here on Options Guy TV. And we'll see you this Friday for the next edition of Options Guy TV. Thanks for coming.